One of the common mistakes when you're looking at overall investing is to figure out whether I should be in the market or outside the market. In 2018, it's more important to think about within the equity markets, your portfolio rotation is very important. One of the areas to specifically watch is the tug of war between cyclicals and what they also call as defensives. Those are two polar opposite areas of the equity market. When the economic environment begins to gather momentum, the cyclical areas tend to outperform. That's the transportation area, that's the chemical area, that's the engineering and construction stocks, that's also the industrials and materials area. Flip side, you've got the defensives, which tend to be more in the healthcare arena or the consumer staples or the consumer durables, which are not directly tied to the level of growth in the overall economy. Now with the economy gathering significant momentum here in the United States, as well as particularly in the emerging markets, the cyclical areas should be the area where a lot more portfolio flow will be going in 2018. In addition, the Federal Reserve is anticipating to hike 3 different times. Overall, the interest rate curve should grind up. If we get excessive or more sharp increases in interest rates because wage inflation begins to take hold, you're going to start to see some pressure not only on the bond market, but also on areas that are bond-like in the equity markets. Real estate investment trusts is an area that tends to underperform significantly in a rising rate environment. Secondarily, you've got the telecoms area and, more importantly, the utility area. They tend to carry high dividend yields that are a competitor to overall bond yields. So when interest rates grind higher and the fixed income market for new investors becomes a little bit more attractive on a yield basis, money managers will tend to sell those particular sectors, take the money as a source of funds and invest it in other sectors that should do better.